In the late 1990s, Enron was the darling of Wall Street. They were known as the smartest guys in the room, celebrated by investors as the absolute peak of corporate innovation. They had transitioned from a boring natural gas pipeline business into a futuristic energy trading giant. Their glittering Houston skyscrapers projected an image of absolute, untouchable success. At the helm, executives Kenneth and Jeffrey Skilling were treated like rock stars, leading a company that Fortune magazine named the most innovative in America for 6 consecutive years. But the soaring profits were an illusion. Beneath the surging stock price, $74 billion of market value was built on data that didn't exist, and it was about to vanish. While executives cashed out millions in stock, they were simultaneously building a machine that would strip their own employees of their life savings inside those very towers. The core of this deception relied on a specific accounting method called mark-to-market. Mark-to-market allowed Enron to book the projected future profits of a deal as actual revenue on the day a contract was signed. They claimed millions in income before a single dollar of actual cash ever arrived. Executives then used those projected numbers to pay themselves massive real-world bonuses based on money that existed only on paper. When projects failed to produce cash, the company hid the losses by sweeping the toxic assets off their books and into a web of hidden shell companies with names like LJM and Chuco. CFO Andrew Fastow managed this labyrinth of debt, ensuring that credit rating agencies never saw the billions the company actually owed. These maneuvers allowed Enron to maintain a flawless facade for investors while its actual debt grew to levels that would eventually destroy the company. To keep the fraud hidden, Enron needed total internal compliance. They achieved this through a hyper-competitive system known as rank and yank. Every year, management reviewed the staff and automatically fired the bottom 15% of employees, regardless of their actual performance. This created an atmosphere of intense paranoia and cutthroat survival on the office floor. To stay out at the bottom tier, employees were pressured to ignore ethical red flags and inflate the numbers just to survive the annual purge. This culture replaced healthy competition with a system of survival that forced silence from anyone who suspected the accounting was fraudulent. The illusion began to crack in 2001. Their broadband projects failed, and public anger surged when traders were caught manipulating California's energy market for profit. In August, CEO Jeffrey Skilling abruptly resigned. Shortly after, Vice President Sharon Watkins sent an anonymous, explosive memo warning that the company was about to implode in an accounting scandal. The external auditors who should have caught this, the Big Five firm Arthur Andersen, ignored the fraud to protect the millions they earned in Enron consulting fees. When the formal investigation began, they shredded the evidence. Arthur Andersen's complicity turned a single corporate bankruptcy into a failure of the entire auditing system, proving that the independent gatekeepers meant to protect investors were actually helping to hide the crime. The end arrived rapidly. On December 2, 2001, Enron reported a catastrophic $618 million loss and filed for Chapter 11 bankruptcy. The Houston skyscrapers remained, but the retirement funds of the employees were entirely wiped out. Workers were locked out of their accounts while executives sold off their own shares for millions. Arthur Andersen, an accounting firm with an 89-year history, collapsed entirely under the weight of the scandal, costing 28,000 people their jobs. The architects faced the justice system. Both Ken Lay and Jeffrey Skilling were convicted of fraud and conspiracy for their roles in the deception. The scale of the fraud forced the passage of the Sarbanes-Oxley Act of 2002, which introduced strict new rules to hold corporate boards and auditors accountable. Enron serves as a reminder that when a company's primary product is its own stock price, rather than actual energy or innovation, the cost of that illusion is always paid by the people at the bottom.
Let's discuss that in the comments section. And as always, thanks for watching Alux Live. Subscribe for more.